Well, headline inflation may be cooling, but it is still stubborn to its core. That was reflected in June's CPI print, which saw headline inflation hit an over 2-year low. Meanwhile, core inflation still hovering well above the Bank of Canada's target. What does this mean for the Bank of Canada's next move? We have Marc Desormeaux, who is principal economist of Canadian economics at Desjardins. Thanks so much for being with us.
My pleasure, Amber.
So we have the headline, it's moving lower. We have the core, which is still sticky, but also moving down. What's the setup for the Bank of Canada?
Well, at Desjardins Economic Studies, we argue that consumers and investors should look through the headline in this case. Yes, there was some good news out of this inflation print. You mentioned that total CPI grew at its lowest annual rate in more than 2 years. But core inflation, the underlying trend of inflation, is still stubbornly high. It's still too high for comfort. It's not at the target we want it to be. So we're not out of the woods just yet.
Does that mean, we're taking a look at it, I mean, it didn't rise as much as headline inflation did or as sharply. But I guess, does that mean it's going to be slower to melt as well?
What is most important to look at here is the 3-month annualized rate of core inflation. There are 3 measures that the Bank of Canada tracks, which it has highlighted several times as being pivotally important to monetary policy. All of these measures are advancing by over 3.5% still on monthly terms. The ex-shelter measure is actually closer to 5%. So this is still far too high for comfort. And it's part of why we need to be cautious when looking at the headline alone.
And yet your base case is we're done here for rate hikes.
It's important to mention that monetary policy works with a lag. When we talk about the peak impacts of an interest rate decision, they tend to occur between 6 and 8 months, 8 quarters, in fact, after that initial decision is made, which means that the Canadian economy has not yet felt the full effects of those first hikes that occurred early last year, let alone the more significant 100 basis point increases that we saw last summer. Because of this, we are projecting at Desjardins that there will be a mild contraction in economic activity towards the end of this year, and that will contribute to bringing prices lower. But we aren't yet at that point.
Mild contraction is a recession.
We think that there will be a mild contraction. 2 consecutive quarters of negative growth meets the technical definition of a recession, but it's mild relative to history, certainly relative to what we saw during the pandemic in the 90s, after the global financial crisis. And a big reason for that is the tightness of the labor market, which unemployment rates near record lows at the Canadian level, still very high job vacancy rates, and lots of momentum in the Canadian economy still.
Tiff Macklem at the press conference last week suggested there is still a scenario in which you can have price stability and continued economic growth, so almost nailing that kind of soft landing scenario. It doesn't sound like that's your base case. Why is that?
Our base case is that there will be a mild contraction in economic activity beginning towards the end of this year. It really is about that sensitivity to interest rates.
Right.
The Canadian economy is highly dependent on housing. There is a lag between when an interest rate decision is made and when the full impacts are felt in terms of economic growth. So for that reason, we do think that there will be a slowdown and a mild contraction as we progress into 2024.
And is that centered around the housing market, eventually understanding that rates are at these levels?
The housing market is part of that story. We see likely a slowdown in consumer spending as well, which drove the very strong print in Q1 in Canadian GDP. Another piece of this story is that we're expecting the U.S. economy to experience more moderate growth in the next few quarters, in part because it has also embarked on a period of aggressive monetary tightening.
How do you layer in structural factors like immigration?
Immigration is important for the Canadian economy over the longer run. We have an aging population. We have job vacancies across a number of industries, and that's contributing not only to weaker profits and weaker economic growth, but also to upward pressure on wages that isn't sustainable. So it plays a role in filling job vacancies. In the shorter run, it also contributes to demand for goods and services across the Canadian economy, and that's part of what the Bank of Canada is trying to grapple with in this economic environment.
If we are at these levels, 5%, maybe even 5.25%, do you view that as, restrictive enough to cool down inflation?
We think that slower economic growth will result from tighter monetary policy in the coming quarters, and that will contribute to bringing prices down closer towards that 2% target growth rate.
And so there's been conversations about we're maybe one, maybe two rate hikes away, but then what happens next? So we basically start pricing in rate cuts, starting next year. There are those who say, no, we just hold here. We're in an environment where we're going to hold in a more restrictive territory. How do you think about how that evolves?
Our base case at Desjardins Economic Studies is that the Bank of Canada will hold at 5% for the remainder of this year and then begin cutting as we get into early 2024. That reflects the fact that we think there will be a slowdown, reflecting that lagged monetary policy impact. And at that point, the bank will deem it necessary to go into less restrictive territory when it comes to monetary policy.
I guess it also assumes there's no kind of double top in inflation, that inflation does not come back.
We think that the overall macroeconomic picture as it exists right now is supportive of prices starting to ease more significantly in the coming months, particularly as those peak interest rate effects are felt. But there is some risk in the short run, given some of the contributors that we saw in this June print, of a reacceleration or some stabilization around the rates we've been seeing in the last couple of months. Just when we think about the fact that energy prices achieved their peak in June 2022, there's a strong base effect in this most recent print. If oil prices start to come up more, then there could be a contribution there. So there may be some upward movement in the next few months when we consider some of these base impacts. But overall, where the economy is going, where we think it will go, these lagged monetary policy impacts, these should contribute to slower price growth in the next few quarters.
All right.